Question 1. Which of the following is a key difference between a health maintenance organization (HMO) and a preferred provider organization (PPA)? HMOs offer more flexibility in choosing healthcare providers than POS. B. PPOS require patients to get referrals from a primary care physician to see a specialist. C. HMOs usually have a network of doctors and hospitals, while PPOS allow patients to see out-of-network providers at higher costs. D. PPOS have more stringent cost control measures than HMOs. Answer C. HMOs usually have a network of doctors and hospitals, while PPOS allow patients to see out-of-network providers at higher costs. Explanation: health maintenance organizations (HMOs) generally require members to use a network of doctors and hospitals and have a primary care physician (PCP) act as a gatekeeper to referrals for specialists. This model restricts access to out-of-network providers except in emergencies. Preferred provider organizations (POS), on the other hand, offer more flexibility in choosing providers. Members can see out-of-network providers, but they will incur higher costs for doing so. Option A is incorrect because PPOS offer more flexibility than HMOs. Option B is incorrect because it describes a typical HMO feature, not a PO. Option D is incorrect because PPOS do not have stricter cost control measures than HMOs. In fact, HMOs tend to have stricter cost management to keep costs lower. Question 2. Mr. Anderson is considering purchasing a disability insurance policy. He has two options, one for short-term disability (STD) and another for long-term disability (LD). Which of the following would most likely be covered under an LD policy but not an STD policy? A. Loss of income due to an injury from a car accident. B. Recovery from surgery after a workplace injury. C. A chronic illness that results in a long-term inability to work. D. Recovery from a broken bone that prevents work for 6 weeks. Answer C. A chronic illness that results in a long-term inability to work. Explanation: short-term disability (STD) insurance typically covers temporary disabilities that prevent an individual from working for a short period, usually up to a few months. Long-term disability (LD) insurance covers more prolonged disabilities, including chronic conditions that may prevent an individual from working for a longer period, often over 6 months or longer. Option A could be covered under both STD and LD depending on the duration of the disability. Option B could also be covered by both depending on how long recovery takes. Option D is more likely to be covered under STD insurance, as recovery from a broken bone typically takes a shorter period. Question 3. Scenario-based. Mr. Richards is the owner of a small business with 20 employees. He is considering offering a group health insurance plan to his employees, but is unsure about how the plan's premiums will be determined. Which of the following factors will most likely influence the premium rates for his small group health insurance policy? A. The total income of the business, including salaries of employees. B. The age and health status of the employees enrolled in the group. C. The number of dependents that employees have. D. The overall profitability of the insurance company providing the policy. Answer B. The age and health status of the employees enrolled in the group. Explanation: for small group health insurance, premiums are largely influenced by the collective health risk of the enrolled employees. Insurers will assess factors like the age, health status, and claims history of the group to determine premium rates. Option A is incorrect because the premiums are based on the health risks and demographics of the group, not the total income of the business. Option C is partially true, as the number of dependents can influence the premium, but the primary factors are the employee's age and health. Option D is incorrect because while the insurer's financial stability might influence pricing, the premiums are primarily based on the health status of the insured group rather than the insurer's profitability. Question 4. Which of the following is a characteristic of a high deductible health PHPA is typically have low premiums and higher out-of-pocket costs, but start cover preventive care services who have lower annual deductibles than standard health plans. Are required to offer coverage for all essential health benefits under the Affordable Care Act. And so typically have low premiums and higher out-of-pocket costs. Explanation: high deductible health initiation are characterized by having low premiums but higher deductibles and out-of-pocket costs compared to traditional plans. These plans require the insured to pay more upfront before insurance coverage kicks in. Option B is incorrect because THES under the Affordable Care Act are required to cover preventive care services at no additional cost to the insured. Option C is incorrect because THPs typically have higher deductibles than standard health plans. Option D is correct. HES are still required to cover all essential health benefits under a cut. However, they differ in terms of premiums and deductibles. Question 5. Which of the following best describes the coordination of benefits COP process when a person has multiple health insurance policies? A. The insurer that provides coverage for the person's primary care doctor will pay the claim first. B. The primary insurer pays the entire claim and the secondary insurer pays any remaining costs. C. The secondary insurer pays the claim first and the primary insurer reimburses them later. D. The two insurers will split the claim payment equally, regardless of coverage type. Answer: B. The primary insurer pays the entire claim and the secondary insurer pays any remaining costs. Explanation: coordination of benefits (COB) is the process used when an individual is covered by more than one health insurance policy. The primary insurer pays first and the secondary insurer covers the remaining amount, depending on the terms of the policies. Option A is incorrect because the primary insurer typically handles the claim first, regardless of whether it relates to a primary care doctor. Option C is incorrect because the secondary insurer does not pay first, the primary insurer does. Option D is incorrect because COB typically does not involve a simple split of payment and it depends on the benefits and the rules set by the primary and secondary insurers. Question 6. Under Ohio's Medicaid program, which of the following is most likely to qualify for Medicaid benefits? A. A middle-aged adult with an annual income exceeding the federal poverty level. B. A child under the age of 19 in a low-income family. C. An elderly person with substantial retirement savings and assets. D. A working adult with private employer-sponsored insurance coverage. Answer: B. A child under the age of 19 in a low-income family. Explanation: Ohio Medicaid provides health coverage to low-income individuals, including children, elderly adults, pregnant women, and individuals with disabilities. Children under the age of 19 from low-income families are eligible for Medicaid under the state's program. Option A is incorrect because Medicaid is designed for those with income levels below the federal poverty line, and individuals with incomes above that threshold are generally not eligible. Option C is incorrect because Medicaid eligibility for elderly persons is based on income and asset limits, and substantial retirement savings could disqualify someone. Option D is incorrect because Medicaid is typically for individuals without employer-sponsored insurance or with insufficient coverage, while someone with employer-sponsored insurance would not qualify unless they meet other eligibility criteria. Question 7. Which of the following is a primary feature of a critical illness insurance policy? A. Coverage for long-term care and nursing home expenses. B. Coverage for specific life-threatening conditions, such as cancer or heart attack. C. Coverage for routine doctor visits and preventive care. D. Coverage for out-of-network medical expenses. Answer: B. Coverage for specific life-threatening conditions, such as cancer or heart attack. Explanation: critical illness insurance is designed to provide financial protection for policyholders diagnosed with serious conditions such as cancer, heart attack, stroke, or other life-threatening illnesses. The policy typically pays out a lump sum benefit upon diagnosis of a covered illness. Option A is incorrect because critical illness insurance does not cover long-term care. That's typically covered under a separate long-term care policy. Option C is incorrect because routine doctor visits and preventive care are not covered by critical illness insurance. Those are typically covered under regular health insurance plans. Option D is incorrect because critical illness insurance is not concerned with network coverage or out-of-network expenses. It provides a lump sum payment for specific illnesses. Question 8. Which of the following would most likely be considered an exclusion in a major medical insurance policy? A. A sudden heart attack requiring immediate medical attention. B. Cosmetic surgery for purely aesthetic purposes. C. Emergency room services for an accident. D. Preventive care, such as vaccinations and cancer screenings. Answer: B. Cosmetic surgery for purely aesthetic purposes. Explanation: major medical insurance policies typically cover essential medical care, including treatments for serious injuries, illnesses, and emergency care. However, they usually exclude cosmetic surgery unless it's medically necessary. Option A is incorrect because a heart attack is a covered condition under major medical insurance as it is a life-threatening medical event. Option C is incorrect because emergency room services, including those for accidents, are generally covered under major medical policies. Option D is incorrect because preventive care, such as vaccinations and cancer screenings, is often covered under the Affordable Care Act account and included in many major medical policies. Question 9. Which of the following is a typical feature of a health savings account (HSA) when paired with the high deductible health AHP? The account funds can be used to pay premiums for health insurance coverage. B. Contributions to the account are not tax deductible. C. The account balance can roll over from year to year without expiration. D. The funds in the account must be used exclusively for emergency medical expenses. Answer: C. The account balance can roll over from year to year without expiration. Explanation: Health savings accounts (HSAs) are designed to allow individuals to save money for medical expenses, and they are often paired with HSAs. One of the key features is that unused funds in the HSA roll over from year to year, unlike flexible spending accounts (FSAs), which typically have a use it or lose it rule. Option A is incorrect because HSA funds cannot be used to pay insurance premiums except under specific circumstances, e.g., for long-term care or COBRA continuation coverage. Option B is incorrect because contributions to an HSA are tax-deductible, reducing the individual's taxable income. Option D is incorrect because HSA funds can be used for a wide range of qualified medical expenses, not just emergency medical expenses. Question 10. Which of the following best explains the concept of subrogation in an insurance context? A. The insured party can recover damages from the insurer after a loss occurs. B. The insurer has the right to recover the amount it paid from the at-fault party or their insurer. C. The insurer must pay a claim even if the loss was due to the insured's negligence. D. The insured party is responsible for paying the full amount of the insurance premium. Answer: B. The insurer has the right to recover the amount it paid from the at-fault party or their insurer. Explanation: Subrogation is the legal process by which an insurer seeks to recover the amount it paid for a claim from the party responsible for the loss or their insurer. This is done after the insurer has paid the claim to the policyholder. Option A is incorrect because subrogation allows the insurer, not the insured, to recover damages. Option C is incorrect because subrogation typically occurs when the insurer seeks reimbursement from a third party responsible for the loss. Option D is incorrect because subrogation has nothing to do with premium payments. It relates to recovering costs after a claim is paid. Question 11. Which of the following is true about a no-fault auto insurance policy? A. The insurance company will always pay for the damage, regardless of who caused the accident. B. The driver who caused the accident is personally liable for damages. C. The insured driver can only claim benefits from their own insurance policy, regardless of fault. D. It requires the insured to sue the at-fault party for damages. Answer: C. The insured driver can only claim benefits from their own insurance policy, regardless of fault. Explanation: A no-fault auto insurance policy is one in which each driver involved in an accident claims from their own insurer, regardless of who was at fault for the accident. This eliminates the need for legal battles over fault, aiming to reduce litigation costs. Option A is incorrect because no-fault insurance only covers the insured's own damages, not all damages regardless of fault. Option B is incorrect because the primary goal of no-fault insurance is to avoid the need for determining fault in the claims process. Option D is incorrect because no-fault insurance prevents the need for suing the at-fault party. Question 12. What is the main purpose of the coinsurance provision in a health insurance policy? A. It requires the insured to pay a fixed amount for each medical service. B. It establishes the portion of the medical costs the insured must pay after the deductible. C. It covers all medical expenses beyond the annual premium. D. It sets the maximum amount the insurer will pay for any medical service. Answer: B. It establishes the portion of the medical costs the insured must pay after the deductible. Explanation: Coinsurance is a cost-sharing arrangement in which the insured pays a percentage of the medical costs after the deductible is met. For example, if a policy has 20% coinsurance, the insured would pay 20% of the cost and the insurer would pay the remaining 80%. Option A refers to copayments, not coinsurance. Option C is incorrect because coinsurance does not cover all expenses. It applies after the deductible is satisfied. Option D is incorrect because the maximum the insurer will pay is usually defined by the policy's coverage limit, not coinsurance. Question 13. Which of the following best describes a term life insurance policy? A. It provides coverage for the policyholder's entire life as long as premiums are paid. B. It pays out death benefit only if the insured passes away within specified time period. C. It accumulates cash value over time and can be used as an investment. D. It offers coverage only for critical illnesses or accidents, not death. Answer B. It pays out a death benefit only if the insured passes away within a specified time period. Explanation. Term life insurance provides a death benefit if the insured dies within a specific term, e.g. 10, 20, or 30 years. If the insured outlives the term, the policy expires and no benefits are paid. Option A describes whole life insurance, not term life. Option C describes whole life insurance, which has a cash value component, while term life does not accumulate cash value. Option D is incorrect because term life insurance specifically covers death, not just critical illnesses or accidents. Question 14. Which of the following is true about an umbrella insurance policy? A. It covers damage to the insured's own property in the event of an accident. B. It provides additional coverage above the limits of existing policies like auto and homeowners insurance. C. It only covers the insured's liability in the case of lawsuit, not accidents. D. It is required by law for all homeowners and drivers. Answer. B. It provides additional coverage above the limits of existing policies like auto and homeowners insurance. Explanation. An umbrella insurance policy provides extra liability coverage beyond the limits of the insured's primary policies, such as auto or homeowners insurance. It can also provide coverage for claims not covered by the primary policies. Option A is incorrect because umbrella insurance is designed for liability, not property damage. Option C is incorrect because umbrella insurance provides additional liability coverage, but it also covers more than just lawsuits. Option D is incorrect because umbrella insurance is not legally required, though it is often recommended for extra protection. Question 15. Which of the following is an example of an exclusion in typical health insurance policy? A. Coverage for preventive care services like vaccinations. B. Coverage for treatments that are deemed experimental or investigational. C. Coverage for emergency room visits for car accidents. D. Coverage for pregnancy-related hospital stay. Answer. B. Coverage for treatments that are deemed experimental or investigational. Explanation. Health insurance policies generally exclude coverage for treatments that are experimental or investigational, meaning treatments that have not been proven effective or are still undergoing trials. Option A is incorrect because preventive care services like vaccinations are typically covered under the Affordable Care Act. Option C is incorrect because emergency room visits for accidents are generally covered by health insurance policies. Option D is incorrect because most health insurance policies cover pregnancy-related care, including hospital stays. Question 16. What is the primary purpose of workers' compensation insurance? A. To cover health care costs for employees injured while working. B. To provide income replacement for employees who voluntarily leave their job. C. To cover long-term care expenses for employees over 65 years old. D. To provide insurance benefits to workers who are involved in workplace disputes. Answer A. To cover health care costs for employees injured while working. Explanation. Workers' compensation insurance is designed to cover medical expenses and provide income replacement for employees who are injured while performing their job duties. It also covers rehabilitation costs and compensation for long-term disability resulting from work-related injuries. Option B is incorrect because workers' compensation covers work-related injuries, not voluntary job separations. Option C is incorrect because workers' compensation is not meant for employees over 65. It is intended for work-related injuries and illnesses. Option D is incorrect because workers' compensation is not related to workplace disputes. It is focused on workplace injuries and illnesses. Question 17. Which of the following is an example of moral hazard in insurance? A. A person driving without insurance because it is too expensive. B. A policyholder filing a fraudulent claim for a non-existent theft. C. A policyholder changing their behavior after receiving coverage for medical expenses. D. A person purchasing life insurance after receiving a terminal diagnosis. Answer. B. A policyholder filing a fraudulent claim for a non-existent theft. Explanation. A moral hazard occurs when a person takes on more risk or behaves differently after obtaining insurance, often leading to unethical or fraudulent behavior such as filing false claims. Option A is an example of a financial risk, not a moral hazard. Option C describes a behavioral change but not a moral hazard. Option D is an example of an adverse selection, not a moral hazard, where a person purchases insurance after learning of a condition they wish to cover. Question 18. Which of the following types of life insurance policies builds a cash value component over time? A. Term life insurance. B. Universal life insurance. C. Group life insurance. D. Accident insurance. Answer B. Universal life insurance. Explanation: Universal life insurance is a type of permanent life insurance that includes both a death benefit and a savings or cash value component. The policyholder can borrow against or withdraw from the cash value over time. Option A is incorrect because term life insurance does not build cash value. It only provides a death benefit for a specified term. Option C is incorrect because group life insurance typically does not accumulate cash value. Option D is incorrect because accident insurance is designed to provide coverage for accidents, not to build cash value. Question 19. What is the primary purpose of a deductible in an insurance policy? A. To limit the total amount the insurer will pay for a claim. B. To reduce the amount the insured must pay out of pocket for a claim. C. To determine how much the insurer will pay before the insured must pay any costs. D. To prevent the insured from making frequent claims for minor damages. Answer C. To determine how much the insurer will pay before the insured must pay any costs. Explanation: a deductible is the amount the insured must pay out of pocket before the insurance company begins to pay for covered expenses. The higher the deductible, the lower the premium, and vice versa. Option A is incorrect because the deductible does not limit the total payment by the insurer. It only determines when coverage begins. Option B is incorrect because the deductible is the portion the insured must pay, not a reduction of their out-of-pocket costs. Option D is incorrect because deductibles are a part of the claims process, not designed to discourage minor claims. Question 20. Which of the following is true about the cost of insurance in life insurance policies? A. It is a fixed premium amount paid by the policyholder to the insurer. B. It covers the insurer's administrative and operational expenses. C. It fluctuates based on the policyholder's age, health, and the policy's performance. D. It includes only the cost of death benefits provided to the beneficiary. Answer C. It fluctuates based on the policyholder's age, health, and the policy's performance. Explanation: the cost of insurance in a life insurance policy refers to the portion of the premium that covers the insurer's risk of paying the death benefit. It can fluctuate based on various factors, such as the policyholder's age, health, and the performance of the policy's investments. For permanent policies, Option A is incorrect because premiums may not be fixed if the policy involves flexible rates. Option B is incorrect because administrative expenses are part of the total premium but not specifically the cost of insurance. Option D is incorrect because the cost of insurance is related to the risk of paying the death benefit but not solely to the death benefit amount. Question 21. What does the term underwriting refer to in the context of insurance? A. The process by which an insurer decides how much coverage to provide and at what premium. B. The process of selling insurance policies directly to consumers. C. The process by which the insured submits claims for reimbursement. D. The legal process of determining fault in an accident or incident. Answer A. The process by which an insurer decides how much coverage to provide and at what premium. Explanation: underwriting is the process by which insurers evaluate risks and determine the terms and premiums of coverage. The underwriter assesses the applicant's risk factors to determine if they are insurable and at what price. Option B describes the sales process but not underwriting. Option C refers to claims processing, not underwriting. Option D pertains to determining liability, not underwriting. Question 22. Which of the following types of insurance is typically required by law for drivers in most states? A. Homeowners insurance. B. Liability insurance. C. Term life insurance. D. Travel insurance. Correct answer: B. Liability insurance. Explanation: liability insurance is required by law in most states for drivers. It covers damages and injuries the driver may cause to others in an accident. Option A is incorrect because homeowners insurance is not required by law for homeowners, although it is often required by lenders. Option C is incorrect because life insurance is not required by law. Option D is incorrect because travel insurance is optional. Question 23. Which of the following is an example of deductible in health insurance? A. A percentage of medical costs that the insurer covers. B. A fixed amount that the insured must pay before the insurer starts covering medical expenses. C. The amount the insured pays for each medical visit. D. The total annual premium for a health insurance policy. Answer B. A fixed amount that the insured must pay before the insurer starts covering medical expenses. Explanation: A deductible is the amount the insured must pay out of pocket before the insurance company begins to pay for covered expenses. Option A refers to coinsurance, not the deductible. Option C refers to copayments, not the deductible. Option D refers to the premium, which is separate from the deductible. Question 24. Which type of insurance provides coverage for damage to a vehicle caused by something other than a collision, such as theft or vandalism? A. Liability insurance. B. Comprehensive insurance. C. Collision insurance. D. Personal injury protection, PIP insurance. Answer: B. Comprehensive insurance. Explanation: comprehensive insurance covers damage to a vehicle from events other than collisions, such as theft, vandalism, or natural disasters. Option A is incorrect because liability insurance only covers damage to others, not the insured's own vehicle. Option C is incorrect because collision insurance only covers damage from collision. Option D is incorrect because personal injury protection, PIP, covers medical expenses, not vehicle damage. Question 25. Which of the following is not typically covered by standard homeowners insurance? A. Damage caused by fire. B. Personal liability for injuries to others on the property. C. Flood damage. D. Theft of personal property. Answer: C. Flood damage. Explanation: standard homeowners insurance generally does not cover flood damage. Separate flood insurance is typically required. Option A, B, and D are generally covered under standard homeowners insurance. Question 26. Which of the following is the main purpose of a rider in an insurance policy? A. To reduce the premium cost of the policy. B. To modify or add specific coverage to the policy. C. To eliminate exclusions in the policy. D. To make the policy invalid in certain situations. Answer: B. To modify or add specific coverage to the policy. Explanation: a rider is an addition or modification to an existing insurance policy that provides extra coverage or alters terms. For example, a rider can add coverage for a specific item or situation not included in the original policy. Option A is incorrect because riders may increase premiums rather than reduce them. Option C is incorrect because riders don't necessarily eliminate exclusions but rather expand coverage. Option D is incorrect because riders do not make the policy invalid. Question 27. What is the term for an insurance policy that combines multiple types of coverage, such as homeowners and auto insurance, under a single policy? A. Bundle policy. B. Umbrella policy. C. Comprehensive policy. D. Multi-line policy. Answer: D. Multi-line policy. Explanation: a multi-line policy is a type of policy that combines different types of insurance coverage, e.g. homeowners and auto, under one contract, often at a discounted rate. Option A, B, and C are related but not specific to the combination of multiple coverage types into a single policy. Question 20. Which of the following is true about life insurance riders? A. They are optional and add additional benefits or coverage to a life insurance policy. B. They are automatically included in all life insurance policies. C. They increase the premium cost without adding coverage. D. They decrease the death benefit of the policyholder. Answer A. They are optional and add additional benefits or coverage to a life insurance policy. Explanation: life insurance riders are optional add-ons that provide extra benefits or coverage, such as additional coverage for accidental death or the ability to access the policy's death benefit early in case of terminal illness. Option B is incorrect because riders are optional. Option C is incorrect because they generally add coverage, not increase premiums unnecessarily. Option D is incorrect because riders generally add to the coverage or benefits, not decrease the death benefit. Question 29. Which of the following is covered by a typical personal liability endorsement in a homeowner's insurance policy? A. Damage to the policyholder's own property. B. Injuries sustained by the policyholder's family members. C. Injuries or damage caused to others while on the insured property. D. Medical expenses for the policyholder's injuries. Answer: C. Injuries or damage caused to others while on the insured property. Explanation: personal liability coverage protects the policyholder in case someone is injured on their property or if the policyholder causes damage to someone else's property. Option A is incorrect because damage to the policyholder's own property is typically covered by other parts of the homeowner's policy. Option B is incorrect because injuries to family members are generally excluded from liability coverage. Option D is incorrect because medical expenses for the policyholder's injuries are typically covered by personal injury protection, not personal liability. Question 30. Which of the following best defines Moral hazard in insurance: a situation where an insured person may engage in riskier behavior because they have insurance coverage. B. A policyholder who engages in fraudulent behavior to maximize insurance payouts. C. A change in the policyholder's behavior due to the knowledge of potential financial loss. D. A risk assessment conducted by the insurer based on the insured's financial background. Answer A. A situation where an insured person may engage in riskier behavior because they have insurance coverage. Explanation: a moral hazard occurs when an individual takes on more risk because they have insurance coverage, knowing that the insurer will cover the financial losses. Option B describes fraud, not moral hazard. Option C describes adverse selection, not moral hazard. Option D refers to underwriting, not moral hazard.